morning to all. My name is Divya Prajapat, student of class 12 Commerce Maths. So today we are going to start a very important topic of macroeconomics, which is national income. So generally, what is national income? Just like every family maintains a balance of its income and expenditure, in the same way the government also maintains a balance of its income and expenditure of an entire nation, which is called as national income. So the proper definition of national income is: the national income is the sum total of factored incomes earned by the normal residents of a country during an accounting year. So what is an accounting year? Which starts from 1st of April to 31st March. In this you can see factored income. So factored income refers to the purchase made by the payments made by the producing units to the households and other people. Next, the normal residents. Normal residents, there are two meanings. One are the ordinary residents who stays in the country for more than 1 year are called as ordinary residents. And the second one is the people who have their economic interest in that particular country. It is a key indicator of a nation's economic health and performance, reflecting the total income earned by the residents and business. It shows the total income earned by that particular country. National income is closely related to other measures like NDP and FC, domestic income, and NNP and FC, national income, which we will read about further elaborately. So the importance of national income. Of course, there are so many importance of national income. The first is economic health indicator. National income provides a broad overview of country's economic performance and advertisements and etc. Policy formulation. It helps government and policymakers make different decisions about what policies to take and decisions about budgeting and etc. Third is living standards. National income data is used to assess the economic well-being of a nation and its citizens. It tells about the standard of living of the people, how is their standard of living. The fourth is income distribution. It also provides insight into the distribution of income among different segments of the country. Now, there is two types of concepts of national income. One is domestic concept and another one is national concept. The domestic concept is the sum total of factored incomes generated inside the domestic territory of the country is called as domestic concept. Means it is only the domestic income of the people of the country living inside the domestic territory of that particular country. The second is national concept. The national concept is the sum total of the incomes generated by the normal residents of a country, whether they are the citizen or not of that particular country. So we will read more about these concepts. Four domestic concepts. We have always listened about the word GDP. Have you ever noticed what is GDP? So the GDP refers to the gross domestic product. It is of two types: gross domestic product and market price. The gross market value of goods and services produced within the domestic territory of a country is called GDP at market price. Why we have used the word market value? If we buy anything from the market, it always includes indirect taxes in it. So in the market price, it is included with indirect taxes. And the next is gross domestic product at FC, factor cost. The gross money value of all the goods and services produced within India's domestic territory is called as gross domestic product at factor cost. It means it excludes indirect taxes and added subsidies. The third is net domestic product, NDP, at market price. Net market value of all final goods and services produced within domestic territory of a country during a particular year, in which we see not gross domestic product, in which we see net domestic product, it subtract depreciation from it, as we are finding the net data. Net domestic product at factor cost. This is calculated by subtracting the depreciation from GDP at factor cost or by subtracting both depreciation and NLP. Moving forward, this is the proper circulation of GDP at MP to GDP at FC. If we have to move from MP, market price, to FC, what we have to do, we have to subtract NIT, net indirect taxes, which includes indirect taxes minus subsidies. Second, GDP at FC to NDP at FC, in which we are moving from gross to net. So we have to subtract depreciation. Third, NDP at FC to NDP at MC. Now we have to go from FC to market price. We will add NIT, net indirect taxes. Now NDP at MP to GDP at MP, net to gross, we will again add the depreciation back to it. So the four national concepts. The first is gross national product at market price. Gross market value of all final goods and services is earned by the normal residents in the country. Now we are learning about the national concepts. So it will be the income which is earned by the normal residents, which is whether they are the citizen or not of that particular country. Second is gross national product at factor cost. The the gross money value of earned by the people of the country, normal residents of the country, whether they are the citizen or not of that country. Net national product at market price. The NNP is the total market value of all the goods and services earned by the normal residents during a specified period, generally a year. The fourth is net national product at factor cost. It's also known as national income. So the net national product at FC is also called as national income, presents the total amount which is earned by the people of the normal residents in that particular country. This is the flow of national income. GNP at MP, GNP at FC, we have to deduct NIT. This is the same process. If we have to move from MP market price to FC, we have to deduct NIT. Then from from gross to net, we have to deduct depreciation. NNP at FC to NNP at MP, we have to add NIT, net indirect taxes. And NNP at MP to GNP at MP, we have to add depreciation to it. So this is for our easy understanding that if we have to move from market price to factor cost, we have to deduct net indirect taxes, as factor cost does not include net indirect taxes. Now if we have to move from factor cost to market price, we have to add net indirect taxes. So what is net indirect taxes? It refers to indirect taxes minus subsidies. So the second is domestic to national. Now domestic income does not include net factor from abroad. Net factor income from abroad, but national does. So we have to add a net factor income from abroad if we have to move from domestic to national income, and then national to domestic we have to deduct net factor income from abroad. Third is gross to net. If we have to move from gross to net, we have to deduct depreciation from it. Now if we are moving from gross to net, we have to deduct depreciation from it, and if net to gross, we have to add depreciation to it. So this is the complete flow of conversion of flow. As you can see, the depreciation from domestic income to national income and back to the national domestic income. So now we have to solve a practical question of national income. So the question is, calculate GDP at market price when NNPFC is equals to 2000, depreciation 200, subsidies 70, income from abroad 110, indirect tax is 180, factor income to abroad 50. So to find out GDP at market price, we have to form a formula. The aggregate which we have to find, we have to write it here, then NNPFC. Now if we have to move from net to gross, we have to add depreciation, then national to domestic minus NFIA. Then from factor cost to market price, we have to add NIT, net indirect taxes. So the value of NNPFC is 2000 plus depreciation 200 minus NFIA. So to find out minus NFIA, we have to deduct net factor income to abroad from net factor income from abroad. So 110 minus 50 plus net indirect taxes. So the net indirect taxes are indirect taxes minus subsidies 180 minus 70, 2200 minus 60 plus 110. So our final answer is 2250. So this is our GDP at market price. So this was the solution of this question. Try to solve more questions like this. Thank you and have a nice day.